Welcome to another Iron Financial Explainer. Our mission here is really simple. We help you forge a stronger portfolio by cutting right through all the market noise and weakness. We don't just skim earnings reports. We take them into the forge and we stress test them. We put the numbers that these companies give us under some serious pressure to see if they crack, to see what they're really made of. And today, the energy giant SLB is on the anvil. They've just dropped their Q1 2026 numbers, and our job is to figure out, is this company built on a solid foundation of real growth, or is it just a house of cards, waiting for the slightest breeze to knock it all down? Let's get into it. So, SLB, let's be clear, this is a titan in the energy services world, a true heavyweight. When SLB puts out a report, the entire industry and Wall Street pays very close attention. Their numbers are kind of a barometer for global energy investment. But this latest report, it feels like it's telling two completely different stories at the exact same time. Honestly, it's a contradiction wrapped up in an SEC filing. On one side, you've got what looks like pretty solid growth. But on the other side, there's this really significant, and I mean significant, drop in profitability. And whenever we see a disconnect like that, you know it demands a much, much closer look. It's a huge signal that there's something going on under the hood that management probably isn't shouting about in their press release headlines.
Okay, so let's put the two main pillars of this report right next to each other so you can see what I'm talking about. On one hand, year-over-year revenue is up 3%. Now, for a company this massive, any kind of top-line growth is worth noting. But then you look at the other side of the ledger, adjusted EBITDA, and remember, that's a key measure of a company's core operating profitability. It is down a staggering 12%. And hang on a minute, that just doesn't add up, right? How can you possibly be bringing more money in through the front door, but have substantially less core profit coming out the back? That is a massive red flag. It's like saying your factory is shipping more product than ever before, but you're somehow losing more money on every single item you sell. That's not a growth story. That's a story about a potential crisis brewing.
And that really is the billion-dollar question, isn't it? Is this 3% revenue growth a true sign of fundamental strength? Is it a solid steel beam that's supporting the company's future? Or is it just, a fresh coat of paint slapped onto a crumbling wall to make things look good for the market? That's what we're going to figure out. We are going to dismantle this earnings report piece by piece. We're going to examine the load-bearing walls of this business, and we're going to determine if SLB is actually building a skyscraper or if they're building a structure that's about to collapse. Let's start the demolition. All right, our first area of investigation absolutely has to be that top-line growth. Where is it coming from? If you listen to management, they're pointing directly at their massive acquisition of ChampionX. And let's be crystal clear about this. This isn't some small bolt-on purchase. This was a transformative, multi-billion-dollar deal that was designed to be a whole new engine for the entire company. So our first test is to isolate that engine and see just how much of the heavy lifting it's really doing. Let's get to the raw numbers.
So here it is. This is the headline number that got everyone's attention. For the first quarter of 2026, SLB reported total revenue of $8.72 billion. Now, on its own, that is an impressive figure, and it represents that 3% year-over-year growth we just talked about. This is the number that makes it into the headlines. It's the number that suggests momentum, that suggests things are moving in the right direction. But as we always say here at Iron Financial, the headline number is almost never the whole story. It's just the first layer of the onion. And now, it's time to start peeling.
Exactly. That growth, it's not organic. It wasn't born from their existing business doing more work or innovating and selling more of their own products. It was bought. This is growth by acquisition. Now, that can be a perfectly valid strategy, but you have to separate it out to see the real underlying health of the original business. It's kind of like a bodybuilder who suddenly gains 20 pounds. You have to ask the question, is that 20 pounds of hard-earned muscle, or did they just strap on a weighted vest right before stepping on the scale? We need to find out exactly how much that vest weighs. And here is the weight of that vest. Of the $8.72 billion in revenue, a full $838 million of it came directly from the newly acquired ChampionX business. Think about that. That is nearly $1 billion in revenue that simply did not exist on SLB's books in the same quarter last year. So when you have 3% overall growth, but you just bolted on a massive new revenue stream of almost $1 billion, what does that tell you about everything else? Well, the math starts to look very, very different. And this, right here, this is the knockout punch. This is the one sentence buried deep inside the report that completely changes the entire narrative. I'll read it directly. Excluding the impact of this acquisition, SLB's first quarter 2026 global revenue decreased 7% year-on-year. Let that sink in. The organic business, the core company that existed a year ago, It isn't growing at all. It is shrinking. And not just by a little bit. It's shrinking by a very significant 7%. So they're not just papering over some cracks here. They literally bought an entirely new wall to hide the fact that the original foundation is crumbling.
So, okay, now that we've stripped away the acquisition, what's actually left? Can the legacy operations of SLB even stand on their own 2 feet? Well, it sounds like we're about to find out. It's time to put that core business under the microscope. This is the real stress test. We need to go division by division to find the specific points of failure. This is where we look for the stress fractures, the weaknesses that could compromise the entire structure. All right, this table breaks it all down, showing the year-over-year revenue change for SLB's main divisions. And you can see a couple of bright spots. Digital is up 9%, and we're definitely going to get to that later. Production systems is up a whopping 23%. But, and this is a big but, remember, that's where most of the ChampionX acquisition revenue is being counted. Now, look at the middle. Look at the real guts of their oil field services work. Reservoir performance, down 6%. Well construction, also down 6%. And these are not minor divisions, folks. This is the bread and butter of what SLB actually does out in the field. This is the heavy machinery, the complex drilling operations, and both of those core segments are going in reverse. And this chart just illustrates the problem perfectly. We've isolated the 2 divisions that really represent the heart and soul of their traditional business. And a 6% decline in both reservoir performance and well construction, that is not a minor dip or some rounding error. These are significant stress fractures appearing in the main load-bearing walls of this company. When the parts of your business that are literally responsible for building the wells and managing the reservoirs are shrinking, it's telling you that the demand for your most fundamental services is weakening. That is a major, major problem. Now, to be fair, management isn't just ignoring this. The CEO, Olivier Lepesche, he directly addressed this weakness in the report. He's pointing to geopolitical turmoil, specifically, and I'm quoting here, widespread disruptions in the Middle East. He says the impact was most pronounced in, you guessed it, well construction and reservoir performance. So this is their explanation for the cracks. They're basically saying it's not a structural flaw in the company itself, but an external shock to the system. You know, a geopolitical earthquake, if you will. The question is, does that explanation really hold up under pressure? Well, that explanation doesn't quite cover this. Look at these numbers. This isn't about revenue anymore. This is about profitability. The pre-tax operating margin in reservoir performance is down 47 basis points. Okay, that's a concern. That's a yellow flag. But now look at well construction. The margin there has collapsed by 463 basis points. That is not a yellow flag, my friends. That is a 5-alarm fire. It is a catastrophic decline. What this means is that for every single dollar of work they do in that division, they are making drastically less profit than they were just 1 year ago. So the problem is twofold. They're doing less work, and the work they are doing is way, way less profitable. The foundation isn't just shrinking, it's getting fundamentally weaker. So the old foundation is clearly showing signs of some serious stress. The core of the business is taking on water. So what are they doing about it? Are they just sitting back and hoping the geopolitical situation gets better? Well, any smart builder doesn't just watch their building crumble. They start building new supports. And SLB's strategy seems to be exactly that. They're trying to forge new pillars of growth in high-tech areas to hopefully offset the decay in their traditional business. So now we need to examine these new pillars and see if they're actually strong enough to eventually carry the weight of the entire company. Let's start with their digital division. This is a really key part of their growth story. The headline number here is an annualized recurring revenue, or ARR, of $1.02 billion. And it's the quality of this revenue that's so important here. ARR is subscription-based revenue. That means it's predictable, it's sticky, and it's usually very high margin. This isn't like a one-off equipment sale. This is a solid, predictable stream of cash flow that they can count on coming in quarter after quarter. This is like a modern, solid steel support beam that they are trying to install into the structure. And it's a good-looking beam. Okay, so $1 billion in recurring revenue is certainly a good start. It proves that they can build something new. But let's be realistic for a second. Given that 7% organic decline in the core business, which is a much, much larger part of the company, is one new support beam really enough? They're losing billions in organic revenue from their main business. They're going to need more than just one new engine to make up that difference. So, is there anything else that has some real momentum behind it, or is this it? And this is where the story takes a really unexpected turn. Buried in the all other category in their report is a little business segment called Data Center Solutions. Its year-over-year revenue growth was a blistering 45%. Let's be very clear about what this means. SLB, the oilfield services giant,
is now in the business of building infrastructure for data centers, and it is their fastest growing segment by a long shot. This isn't just a new support beam, this is them trying to build in a completely different architectural style. It's a powerful, high-growth engine for sure, but it is a massive departure from their core identity. And it seems like they are doubling down on this tech-forward strategy. They recently expanded their collaboration with NVIDIA, the absolute titan of artificial intelligence. And their goals are incredibly ambitious. They want to design AI infrastructure and co-develop what they're calling an AI factory for energy. Now, this is all very forward-looking, it's very buzzword-heavy, but an AI factory, that sounds like a project for 2030, not something that's going to fix a 463 basis point margin collapse today. So the question is this a genuine new foundation for future growth, or is it a high-tech distraction from the very real problems they are facing in their core business right now? It's a legitimate question. Okay, so what we have here is a company in a massive state of transition. The core is clearly weak, but these new high-tech growth areas are starting to emerge. Now, during a period of such deep uncertainty and structural change, what is management doing to keep their investors from panicking and running for the exits? That's the critical question. So let's examine how SLB is treating its shareholders. Are they shoring up confidence, building a stronghold to protect investors through this really volatile period? And the evidence shows they're being very, very friendly to their shareholders. In just the first quarter alone, they spent $451 million to buy back 9.2 million of their own shares. And on top of that, they approved another healthy quarterly dividend. From management's perspective, these actions are meant to signal immense confidence. It's their way of saying, hey, we believe in our long-term plan so much that we are using our own cash to buy our own stock and to reward you for sticking with us. It's a pretty powerful message to send to the market. But here's the counterargument. The CEO has publicly committed to returning more than $4 billion to shareholders this year. That is a massive amount of capital. Now, when a company's core operations are shrinking and its profit margins are collapsing, is spending billions of dollars on buybacks and dividends really the most prudent use of that cash? Or is this a defensive maneuver? Is it a way to put a floor under the stock price and keep the market happy while they try to fix the fundamental problems going on in the business behind the scenes? You see, it can be viewed as either a huge sign of strength or an act of financial engineering to mask a serious weakness. All right, we have been through it all. We have stress-tested the top-line numbers, we've examined the cracks in the core business, we've assessed the strength of their new high-tech pillars, and we've looked at how they're treating their investors. It's time. It's time to weigh all the evidence. It's time for the iron financial verdict. Let's assemble the bull case and the bear case and finally decide if this company is an opportunity or if it's a trap. This is what it all comes down to, right? We've seen all the conflicting evidence. We've seen clear signs of growth and clear signs of decay, and they're happening at the exact same time, all under one corporate roof. It's a truly fascinating case study. So what is the essential truth of this company right now? Is this a story of a legacy giant that's successfully pivoting to a high-tech future? Or is it the story of a company desperately trying to buy growth to hide a rapidly deteriorating core? Let's break it all down. Okay, the bull case, the argument for this being a great opportunity is pretty clear. Management saw the serious headwinds their core business was facing, and they made a bold move with the ChampionX acquisition to buy immediate growth and market share. And at the exact same time, they are successfully building out two new, incredibly promising pillars in digital and data center solutions. The bulls would say these are the future of the company, and management is rewarding shareholders for their patience during this critical transition. But then there's the bear case, the argument that this is a trap. And it's just as compelling. The bears would say the ChampionX acquisition is nothing more than a mask. It's just hiding a core business that is shrinking at an alarming 7% rate. And even worse, the profitability of that core business is in an absolute freefall. The new tech ventures are exciting, sure, but they are still far too small to carry the weight of the entire company. And those massive capital returns, they feel more like a tactic to distract investors from these deep structural problems. So the iron verdict is this. SLB is a company that is engaged in a high-stakes, high-risk construction project. The original foundation, its core energy services business, has developed serious, undeniable cracks. In response, management is frantically trying to build and buy new support pillars with big acquisitions and new technology ventures. The entire investment thesis rests on one single critical question. Can they build these new pillars fast enough and strong enough to take the weight before the old foundation gives out completely? This is a turnaround story in the truest sense of the word, and it is definitely not for the faint of heart. It is an opportunity for those who believe in the new construction, and it is a trap for those who believe the old cracks just run too deep. And the final question for you is, Do you have the conviction to invest in a building that's still under construction?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.